Again, my name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Today we're going to talk about avoiding common mistakes in your 401k plan for ConocoPhillips employees. And a lot of that really centers around tax planning strategies. Before I get started, I just want to remind everybody again that the Retirement Group, we're not employed by nor are we affiliates of ConocoPhillips. Also, throughout the course of this webinar, if you have any questions, feel free to jot those down in the Q&A box that you see on your screen. Your information is anonymous, your name will not be shown. And I'll try to get to as many of those questions as we can at the end of the webinar. But if we are short on time, I'll be happy to follow up with you one-on-one to answer some of those questions as well. Also, we've got a chat box in there as well where we will be putting some information from time to time, items as far as like how to follow us on LinkedIn if you want to stay up to date on the ConocoPhillips information, how to schedule an appointment with myself or one of the other advisors. And then we may put some information there about a survey if you would like to give us a hand and let us know how this webinar went or any suggested changes we should look at in the future. And I believe there may be a box of cookies coming your way if you take a little bit of time out of your day to let us know how we're doing or give us some suggestions. Now, with that, I want to go ahead and get started again and remind everybody who doesn't remember who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for just about 30 years or so, and we work with a select group of companies. Obviously, ConocoPhillips is one of the companies we've been doing some extensive work with over the years. And the reason we only work with a certain number of companies is it allows our advisors to have a deeper understanding of the benefits plans inside and out so we can help you with that transition process into retirement, whether that's this year or whether it's 5-10 years down the road. It allows us to give you all the ins and outs of your benefits plans and help you determine the best day to retire so you maximize your benefits as you leave the company, which in turn can maximize your retirement savings throughout the rest of your life. Now, we've got offices throughout the country, so rest assured if you need to sit down and talk with one of us face-to-face, we can still accommodate that. But we also can set up web meetings, phone calls, emails, all of that information is available as well to answer your questions. And if there's anything you take us up on at the end of the day is to go through a cash flow analysis with us. If it's been a while, we can update it as well. But ultimately speaking, this is the most bang for your buck because it's a complimentary service. And we'll spend about maybe 10 to 15 minutes gathering some data from you. And we'll spend a little bit more time putting together a full report, for you to let you know exactly how you stand as far as your retirement goals. Are you on track? Should you save more? Could you retire earlier? Should you work later? We'll go through all that. We can also look at various scenarios if you're trying to figure out different dates as well as strategies and how they affect you with taxes and the benefits as well. Now again, today we're going to talk about taxes, but before I get to that, also there's a QR code here up on the screen. So if you have if you'd like to follow us along on LinkedIn to stay up to date on all the ConocoPhillips changes, we'll be happy to keep you updated on that as well. So just go ahead and hold your phone up there, and you can do that. There will be another one at the end of the webinar as well, though. So as far as the taxes, we're going to talk about some different things, some changes that happened with the Secure Act last year. We'll talk about required minimum distributions. We'll talk about stretch IRA changes. We'll talk about age restriction changes. We'll go through the tax brackets for both federal income and long-term capital gains. We'll talk about different state tax bracket issues to be aware of, and then we'll also go through the different potential changes that could come about with the administration change we saw last year as well. So before we get into that, one of the biggest things we went through as far as a change last year was the Secure Act of 2020. There were some good and bad things associated with this, and one of the first good things was it actually extended the required minimum distribution age from age 70.5 to age 72. So what this means is that it gives you an extra year and a half or so that you can actually defer your assets if you want to defer having to pay taxes on them. However, what it also does is if you're working with a company like the Retirement Group, where we do employ some tax strategies, it gives us an extra year and a half of employing some tax strategies to help you minimize your taxes for not just yourself, but your beneficiaries down the road as well, especially given the other change that did come about, which is a pretty severe negative. One of the things they changed was they eliminated the stretch IRA options for non-spousal beneficiaries. It used to be that if you passed away and you passed on your IRA or 401k to, excuse me, if you passed on your IRA to a non-spouse beneficiary, even if it wasn't your wife or husband, then your kids, for instance, they could take it out over the rest of their life and take out a little bit by little bit, so it doesn't hit them heavy on the taxes. Unfortunately, they changed that last year, and you were required to take it out within 10 years, whether it's taken out roughly 1/10 a year, or all at the beginning, or all at the end. It's up to you. I unfortunately have had to go through this twice with clients last year that passed away, and one actually passed away early January last year, so right after the rule was changed, which is kind of a shame because he had passed on his assets to two of his kids. So both of them, they split the assets and have to take that money out within that 10-year period. So the best tax strategy is obviously to take out, roughly 1/10 a year, give or take, market fluctuations, but also analyze your tax brackets to determine the best way to do that. So the biggest issue here is it's a way for the government and the IRS to essentially, look at trying to tax a lot of the baby boomer transition assets more rapidly than what they were doing before. But it's still, if you pass on to a spouse, they can still stretch it out. It's just the kids or non-spouse beneficiaries that have this issue. Another positive they changed was actually doing away with the age restrictions for contributions to IRAs or Roth IRAs. It used to be tied to the RMD age, which was 70 and a half, but now there's not a restriction. So you can go out there and you can be 80 years old and working at Home Depot or Walmart or whatever you want to do, or still consulting, and still be able to make contributions to a Roth IRA or a traditional IRA. So that's another positive benefit that you have in those changes. Now we get into the tax brackets. Let me zoom in here a little bit because obviously there's going to be a little bit busy. But if we look at the tax brackets, keep in mind whenever you file your federal tax brackets, it's a graded schedule. So the first section is going to be 10%, then 12%, 22, 24, 32, 35, and 37%. So again, it goes up as you make more income, and you'll see the biggest jump really is from that 12% to the 22% tax bracket. It's a 10% jump there. These are the same as they've been for the last couple of years. It's just they're adjusted each year for inflation. These are set to sunset after 2025, but we'll see again if there's any adjustments or changes to it during the current administration before 2025. But as far as the where these are important, it's important to know your tax bracket. We'll talk about some different distribution strategies later. But I mentioned before about tax planning strategies before your RMD age. One of those would be Roth conversions. So let's take a look at that second column, maybe a married couple. If we scroll down to the 12% bracket, we'll see the top of their bracket is actually $81,000. Now, on top of that, the standard deduction is $25,100. So what that means is a married couple can earn or withdraw from their IRA or 401ks $106,000 or less and stay in that 12% tax bracket. So I would argue that ultimately speaking, that 12% is I would argue that 12% is probably a pretty low tax bracket for now and for the rest of your life, because it's highly probable we'll see tax brackets go up down the road given all the government spending. So it's very important to maximize that 12% tax bracket. So an example for that Roth conversion would be maybe somebody was actually only taking out $70,000, a married couple, for their income needs. That meant they had another $36,000 that they could take out in that 12% tax bracket. So we'd recommend taking that out, converting it over to a Roth IRA, paying the 12% tax bracket, and then being done for that for the rest of your life, or extend it to your beneficiaries' lives. And if you can do this year by year, then we can slowly get some money out of your IRA to reduce the amount that has to come out during that required distribution that we mentioned previously as well. So any question on that, we can go through and be more specific on the tax strategies. And it's important to know this year by year, because it helps you change year over year as far as your planning strategies. Now, also, you've got the long-term capital gains tax rates, which are going to be either 0%, 15, or 20%, again, tied to your income tax bracket. Another great thing for ConocoPhillips employees is you've got the leverage stock within the 401k plan. So you can exercise NUA, which is net unrealized appreciation on that. And what's going to happen is the growth on there will be long-term capital gains, and you'll pay that long-term capital gains rate, which could be 0% or 15% or 20%, but usually it's going to be 15%. And again, if we're working with you on the taxes and we budget it year by year, we can possibly get that down to the 0% tax bracket in some given years, and saving you at least thousands, if not tens of thousands of dollars in the NUA process as well. And we'll talk a little bit about some potential changes we're seeing with that coming up. Now, it's not just federal tax we need to look at. Let's zoom in here and look at some of these states. You've also got potentially state taxes that you're going to have to pay on your retirement distributions. And so it depends upon what state you're living in. Obviously, states like California, New York, Illinois have got high income taxes. So you can see as high as 9 or 10% on top of what you're paying for your current tax for your federal taxes. So it's very important to review this. We work with a lot of people that transition to different states. I'm working with 3 right now that are moving from high income tax bracket states, and 2 are moving to Florida, and 1 is moving to Texas where there's no income taxes. But even on top of that, there's also keep in mind there's a few states that they may have income taxes, but they actually don't tax you on retirement distributions. It's going to be Mississippi. I believe it's Mississippi, Hawaii, and Pennsylvania do not tax you on pension and IRA distributions. I think Alabama and one other, I think, taxes you on 401k and IRA distributions, but not on pension distributions. So we can go through all this when it comes time for that cash flow analysis to really show you the differences as far as how much it's going to cost you in one state versus the other as well, as far as going through what the long-term picture is going to look like, what the tax effect will be for you on those distributions. Now, as far as the changes that we might see coming up, we'll talk a little bit about the changes that are already in process for 2021, as well as some potential changes that we could see coming up in the next year or so. And there's a lot here to go through, so I'm not going to go through all the details of it, obviously, but some of the changes that have already gone through for this year is the Consolidated Appropriations Act, which essentially was the disaster relief funds that were sent out early in the year. You've also got the American Rescue Plan. One of the key things that's looking at is the bump up in the child tax credit, as well as the actual prepaying of that tax credit to individuals we're starting to see right now versus having to wait for filing it on your taxes. There's a lot of other little nuances to it, but that's one of the big things. And then the standard deductions and everything of that nature, those are just going to increase with inflation as we've seen year by year. And then there are some planned changes to the alternative minimum tax, which is a positive thing. For the last 8 years or so, we haven't seen much as far as a tie to inflation, so that's been adjusted. So now less people in the middle class will be getting affected by alternative minimum tax brackets, and that's again where it was set up initially to help avoid the wealthy doing different tax strategies and providing a minimum tax for them. But unfortunately, it got a lot of middle class earners caught up in it as well. So that's been bumped up, so it should not catch as many people, hopefully, this year and going forward. And then just the retirement distributions, we talked about some of the changes as far as the Secure Act already, but also we had the CARES Act last year in 2020, which allowed you to take distributions prior to age 59.5 up to $100,000 out of your 401k or IRA. Without the 10% penalty. It also gave you some different rollover options. That has not been extended into 2021 at this point, so we're back to normal for that. And then there's just some bump up in deduction limits for long-term healthcare premiums, health savings accounts, as well as flexible spending accounts. And there's a lot of other little nuanced things in there, but we're not going to spend all the time going on that. If you have questions, let us know. We can run through that with you. Or again, you can contact your CPA on any specific items. Now, some of the changes that are expected coming up is going to be first off a potential raise on the top tax bracket from 37% back up to 39.6%. So that's again one of the pushes to have the higher income earners pay their fair share or so as what's being pushed for it. So that could generate some additional revenue. Also, the biggest thing, or 2 of the big things to look at, are going to be some potential changes to appreciation of assets. So one is potentially changing the long-term capital gains bracket that I showed you before was 0, 15, and 20%, and they're looking to match that to your income tax bracket. However, it's just for those that make over $1 million a year. So instead of paying 20%, they could be paying as high as at 39.6%. So effectively doubling that. So again, if you're making over $1 million a year and you have this problem, give me a call, because there's probably some estate planning issues to review as well. But for most of us, that's not going to affect us. The one I'm more concerned about is actually the doing away with the step up in cost basis, because this is something that does affect ConocoPhillips employees, especially when we talk about NUA, which again is that net unrealized appreciation. A lot of times what we'll see is people process NUA and hold on to the Phillips or the Phillips 66 or the ConocoPhillips stock for a long period of time, and if they don't ever sell it and they pass away, generally speaking, it will get a step up in cost basis for their beneficiary. Same thing when you look at real estate, art, things like that. So let's assume that maybe you've got $50,000 worth of stock, and you sit on it for 20 years, and it grows from 50,000 to, let's say, 200,000. Well, right now under the rules, if you never sold it, your beneficiaries inherit it. They inherit it at that $200,000. So that's now their new cost basis. So you essentially got $150,000 of growth without having to pay the taxes on that, or your beneficiaries having to pay the taxes on it. So the new change would be eliminating that, and essentially they would have to pay the taxes, so they wouldn't be getting the full 200. They'd be getting the 200 less taxes associated with it as well. There's also going to be they're looking at applying the 3.8% Medicare surcharge taxes to pass through businesses. So again, just another way to capture more taxes there for those that are trying to possibly protect against it or looking at more passive income. And then they're going to look at hopefully extending that child tax credit that we mentioned, the bump on that going forward, make some of the ARPA changes permanent, hopefully, make some enhanced healthcare, health insurance changes, premium tax credits permanent as well. So there's just some of the things that are being kicked around right now. We'll see if this comes to fruition for 2022, or if it goes beyond that, or if there are some additional changes as well. But we'll be sure to keep you updated on it. Now, when it comes to looking at the IRA and the 401k and some transition planning, there's a couple things we'll go through. We'll talk about the different lump sum options you have on your 401k and the rollover, and we'll also look at some backdoor or spillover after-tax Roth strategies. We'll talk about the conventional withdrawal strategy that most people look at, and maybe some alternatives you should look at as well. The general tax situations when it comes time for taking distributions. And then again, we'll end up on the required minimum distribution, and we'll wrap it up. So as far as whenever you retire from ConocoPhillips, you're going to have two different plans. You're going to have your defined benefit plan, which is your pension plan, depending upon when you were hired and what company. It could be a classic pension plan, in which case you get the annuity, or you can have a lump sum, or maybe the cash balance plan, which you start off with a cash balance lump sum, or you can change it to an annuity. And then you've also got your savings plan, which is your 401k, where you and ConocoPhillips have been making contributions, and it's going to go up or down based upon market fluctuations. You have the option to keep that in the 401k, or once you do retire, you can roll it over to an IRA if you want more selection and more choices, or if you want to work with a firm like the retirement group. If you take the pension as a lump sum or the cash balance plan as a lump sum, then you can also combine that and roll that over as well. By doing that, it's just essentially a transfer into an individual retirement account. So there's no tax ramifications of that, because you're just going from one tax-deferred account to another tax-deferred account, again, in order to get more selection for a do-it-yourself approach, or more help from a firm like the retirement group. Now, currently within your 401k plan, you have the option to make after-tax contributions. You may have done this over time. You may have some after-tax money already in the 401k plan, or you may sit down with myself, one of the advisors, and kind of review this strategy to look at possibly adding after-tax contributions. The pre-tax contributions, they give you a tax deduction now when you take them, but eventually you're going to pay taxes on those again, plus any earnings that you have on there. So it's all tax deferred, not until you retire or take distributions. The after-tax money goes in, you don't get a tax benefit right now, but you'll never have to pay taxes on that cost basis again. However, in the 401k, you do have to pay taxes on the growth. So let's assume that maybe over time you've put in $50,000 of after-tax money. And what's going to happen is if that sits in that 401k for another 5-10 years, and let's say that it doubles and grows to $100,000, eventually you're going to pay taxes on that growth of that $50,000. However, if we get you to roll that over to a Roth IRA, as long as it stays there for at least 5 years and you're over 59.5, all the earnings on that will be tax-free. So again, this can save you, $1,000 in taxes, or it could go higher especially if you're looking to pass this on for beneficiaries. It's also a way to reduce that required distribution and provide some more tax planning down the road for you as well. Now, if you don't have any after tax in there, it's still something we can have a review about and talk and look at what your budget is and figure out how much do you want to get for a tax break on pre-tax now versus putting in after-tax money and rolling that over to a Roth IRA every year. So effectively, you can actually fund a Roth IRA with much more money than the standard $6,000 per year limits by doing it through the 401k plan. So again, just give me a call if you have any questions on that. We'll be happy to go through it. Now, when it comes time for distributions, this is really kind of the classic conventional withdrawal strategy that we see a lot of individuals do, in which case you first focus on your brokerage accounts and your after-tax accounts, your savings, because again, the age-old philosophy is to defer your taxes as long as you can. And then the second you start looking at your tax-deferred accounts, and then ultimately you look at your tax-free accounts, whether it's your Roth IRA or municipals. So this is kind of the old school plan. Unfortunately, given where we are right now with tax brackets, I would argue to say they're probably some of the lowest we might see for a while. So the problem with this plan is if you keep deferring your taxes, we don't know where tax brackets will go, and there's a chance, depending upon how much you have to take out, you could be paying more taxes later than you could now. So that's where it's important to review the different options. If we look at this specific strategy, this is again the conventional strategy of let's say somebody who's actually needing $60,000 a year and they retire at 65. We see the first 2 years they actually deplete their taxable assets. So maybe they're, some of their savings or brokerage account. Then Social Security kicks in at full retirement age for them, which is 67, but it doesn't cover the full 60,000. So that blue is them taking distributions from their IRA or 401k, which is the tax deferred account, and they'll pay taxes on that, and that will also kick into them having to pay taxes on Social Security as well. And then eventually they possibly could run out of that, and then they'll tap into their Roth IRA or any other tax exempt that they're looking at. So this is the classic strategy where again it's going to look at deferring your taxes. However, we would suggest looking at maybe a combination approach, in which case you will actually tap into your retirement assets earlier versus simply still deferring it. So we look at the first 2 years here, we're showing actually taking tax deferred assets as well as taxable assets, so you can stretch those taxable assets out longer. The reason there is it's going to help you manage those lower tax brackets, because if you went and just took all taxable income and you didn't have any income for the year, you wouldn't have any income taxes, which is nice, but I would still argue it might be more appropriate to pay a little bit of taxes at 10 or 12% bracket, or even look at Roth conversions before tapping into all of your taxable money. And then once that runs out, you'll have the option to budget it and look at taking some of your tax deferred and taking some of your tax-free accounts side by side, year by year. The difference or the reason for this is because tax brackets, as we've seen, they change from year to year, or at least blocks of years, based upon administrations or Congress that's in charge. So in theory, if tax brackets go up down the road, which is quite a possibility, then it may be more beneficial to have that strategy and have the ability to take more from your tax-free in those years, and then if and when tax brackets change, take more from your tax-deferred. And this goes again hand in hand with the Roth conversion strategies we talked about and other tax planning strategies we can review between now and your required minimum distribution age. So to implement this, there's really kind of a simple 3-step process. It's just again fill up your lower tax brackets with your tax-deferred income each year. So again, maybe get up to that 12% bracket, but maybe not jump up to the 22%, because that's a 10% jump there. And then make sure you're aware of the Social Security taxes as well, because there's differences in Social Security tax based upon your income. And then strategically use the additional assets like the Roth IRA to supplement your distributions and help manage your tax brackets going forward. So when it comes time for taking distributions, there's actually potential taxes on top of your ordinary income taxes. If you take a distribution, generally speaking, before age 59.5, you could be hit with a 10% penalty on top of that. Now there are some different exceptions as far as if it's being used for medical expenses, first-time home purchase, education expenses, things like that. But for standard distributions, if it's under 59.5, you're going to be looking at a 10% penalty. Unless there's 2 strategies that we look at in order to avoid this. One is the age 55 rule. So if you retire from ConocoPhillips the year you turn 55 or later, you can actually take distributions from the 401k without the 10% penalty. So as fiduciaries, at the end of the day, we'd love to help. We'd love to help you manage your assets, but we will actually tell you to keep money, at least something in your 401k plan, even if you don't think you need it, if you're retiring before 59 and a half. So you have that option to tap into it for that age 55 rule without the 10% penalty. Now, if you retired before or you rolled over already and you want to take distributions from your IRA without the 10% penalty, we can still do that with the 72T, which is a substantial and equal periodic payment process. That's based upon IRS regulations, where you have to set it up for at least 5 years or until you're age 59 and a half, whichever is going to be longer. And it's a strict policy, but we do this with plenty of clients, and you need to understand the policy and work with a company that does know it, because if you make a mistake, they will go back and retroactively penalize you for all that you've taken out over that time period. And then, as we mentioned, this is once you hit 59 and a half, you don't have to worry about that 10% penalty. You don't have to worry about taking anything out if you don't want to or don't need to until you hit RMD age, which again we said was changed from 70 and a half to age 72. So really from 59 and a half to age 72 are kind of the freestyle years where you have more control over your distributions, and the IRS is not telling you what the taxes could be or telling you that you have to take something out. So again, that's really the sweet spot, in which case we work with you on tax planning strategies to help you save quite a bit throughout the course of retirement, and possibly quite a bit more for your legacy if you're passing something on to your beneficiaries. So if you retire, let's say at 65, then you've got 7 years of some planning there. If you retire at 60, you got 12 years there. But this is something that we do go quite in depth on, helping you manage the taxes, not just the investment strategies when we're working with clients. Now, the best way to bring all this together and uncover anything that you may not be aware of is by running that cash flow analysis I mentioned before. Right now, unfortunately, about 3/4 of Americans over 50 don't actually have a plan. As I said, if you can spend about maybe 10-15 minutes with us, we'll gather some data from you, and we'll spend about a week putting the plan together and get it back to you. And we'll provide you with a detailed cash flow analysis to show you exactly where you stand, and not just what it looks like now, but what it looks like in 10, 20, 30 years down the road. And that helps us back into some of this tax planning strategies we talked about, and we can show you the difference as far as how the taxes can play a key part over the next 20 or 30 years by looking at that plan and looking at alternatives for you as well. Now, we talked a lot about this, but at the end of the day, we'd love to work with you if you have questions on investment sides as well, or you need help with that transition process, or you have questions on taxes. If you work with somebody already, that's great. We understand that, and we applaud you for it. But we do, however, recommend that you get a second opinion if you do have some questions or want to make sure that they're providing you the right service. We even recommend our own clients do this from time to time just to keep us on our toes. But at the end of the day, you want to make sure you're working with somebody that has a good understanding of the ConocoPhillips benefits plans, so they can help you avoid mistakes when you transition into retirement. Some of those mistakes we haven't gone through in detail today, but we do in our other webinars, especially with the pension planning webinar. And then you also want to make sure you understand the fees. You're always going to pay fees, even in the 401k. They're very low. If you go to a do-it-yourself approach, they're very low, but they're still there. If you work with a company like the retirement group or somebody else, then there's going to be fees charged to help you manage those assets. So you need to make sure you understand that fee structure and make sure you're getting what you're paying for as well. I can tell you how many times I've talked with clients that were working with an advisor and didn't think they were getting charged, and we took a look at the statement to show them where it was. So just make sure if you're working with somebody, you go ahead and reassess that and make sure you're getting what you're paying for. And make sure you're working with the team. Myself, the other advisors here, we can't do everything on our own, so we rely a lot on the back office support of the retirement group, also Charles Schwab, who we clear through. And we rely on them to help us with a lot of the investment decisions as well, because myself and the other advisors can't wear every single hat at every second of the day as well. And then at the end of the day, figure out what it is that you are looking for, and hopefully the firm you're working with will support that. And you need to run that cash flow analysis and run it from a conservative standpoint, and make sure you update it periodically, because the markets change and lifestyles change as well. So make sure that if you haven't done one in a while, you give us a call and we can run through it and update it for you. So now we spent a lot of time on that. It was a kind of a deep subject, and there's a lot more that can be covered one-on-one. So if you do have any questions, just give us a call at 1-800-900-5867. You can also reach us at info@theretirementgroup.com. And again, if you're tech savvy, we've got a couple QR codes here up on the screen if you want to hold your phone up to it. If you want to follow us on LinkedIn, where we'll keep you updated on the next webinar for ConocoPhillips and any company plan changes we see coming out. And then also, if you'd like to schedule an appointment with myself or one of the other advisors, there's also a QR code there as well. And because we ran a little bit late and covered a lot, I'm going to try and answer quickly 2 questions that we are looking at that came in. And one of them was can I convert my pension to a Roth? So let me kind of clarify this. So the pension, it really depends. Again, your pension is going to give you either an annuity or a lump sum. So if you take the lump sum, what you can do is you can roll that over to a IRA. And then from there, if you want to convert that IRA to a Roth IRA, you could. Now, a lot of times a pension lump sum is a pretty sizable amount, so you may not want to convert the entire thing over in one single year because it's going to put you in a high tax bracket. Whereas we can actually work with you on a strategy to maybe convert over the course of 2 or 3 or 4 or even 10 years, depending upon the amount. So you can get that out and moved over to a Roth IRA with less tax issues, and that will shorten your break-even point in order to recoup the taxes, so that now everything going forward is going to be tax-free. So an example, let's say if you had $1 million and you want to do an entire Roth conversion there, that's going to put you up in the highest tax bracket, and you might lose 40% of it after you factor in all taxes. So now you're only left with $600,000, and it's going to take you some years to grow that back to $1 million. But once it grows back to $1 million, anything above that's going to be a benefit to you because it's all tax-free growth from that $600,000 beyond. But once you get back to $1 million, that's when everything's working in your favor. And then the last question that we had was how is Social Security taxed? So I'm not going to get into this in great detail because we do have a Social Security webinar you can go online and pull where we go through it. But ultimately speaking, I had a slide there where we were talking about Social Security can be taxed based upon your tax bracket. If you got no income and you're just looking at Social Security, or you're taking Social Security and savings that are not taxable, your Social Security would be 0% taxes. However, once you get up to, depending upon if you're single or married, if you get into that $30,000 to $44,000 range or so, you're going to start looking at having to pay taxes on 50% of your Social Security. If you go above that, you'll have to pay tax on 85% of your Social Security. So that's when you're taking retirement distributions. And that's why I said it's interesting to budget year by year, because we may see or make changes where one year you just take from your savings and you take your Social Security, so it's not taxed. And that allows you to get your long-term capital gains rate down to 0% as well. So there's a lot of tax strategies to look at there. So I know we went long. I want to thank everybody for taking the time to join us today. And again, as I said, just give us a call at 1-800-900-5867. We'll be happy to go through some of these questions in depth, and if I didn't get to your questions, we'll go ahead and follow back up with you on them as well. But I want to thank you all for taking a little bit of time out of your day and joining us, and I hope everybody has a great day and stay safe.